welcome everybody. It's Wednesday, the 21st of April. I'm Rob Murphy, head of the investment companies team at Edison, and it gives me great pleasure today to welcome three managers of value and income focused trusts, and we're going to be talking about finding value in global markets. So I'll just go around sort of clockwise and introduce the people. So first of all, we have Mike Curley. He runs the Henderson Far East Income Trust, and that's run by Janus Henderson Investors. Going around clockwise, we have Joe Baumfreund. He is CIO and CEO of Asset Value Investors, and he runs the AVI Global Investment Trust. And finally, we have Aleister McKinnon. He's a fund manager of the Scottish Investment Trust. So welcome everybody on the call. And to start off with, let's just sort of set the scene a bit. If we could have a poll. So if participants just tick which option they think is the most fits in with their view. So how likely is it that value investing will outperform growth investing during the next 12-month period? So if people just click their view there, please. Okay, so likely is 55%. Okay. So most people actually are sort of fairly optimistic about the growth strategy. So that's good to see. So you're definitely on the right webinar then. So you've got three experts. So to start off, I'd like to introduce Aleister George. He's Edison's strategist, and Aleister's going to just set the scene from a macro point of view. And has a few interesting slides to show on value investing. Here we go.
Okay.
So please go ahead, Aleister.
Okay, thank you, Rob. Jan, if you could just put it on straight onto the first slide, please. Thank you very much. Yes, so this one here, just the we also favour value during the COVID recovery. We can see a 2-year COVID recovery period of loose fiscal and monetary policy ahead from a top-down perspective. And we think, to some degree, we can understand if investors feel that they're at something of a crossroads, having maybe ridden a remarkable recovery in equity markets, which now look in aggregate possibly a little expensive, for still very low interest rates, still very low bond yields compressed by ongoing quantitative easing. But during this presentation, I'd like to sort of highlight maybe that there isn't a dilemma, that if you split the market out a little bit between value and growth, you can still find reasonable opportunities there with value sectors well positioned, better value, and in this transition back to the real economy, better fundamentals. So next slide, please. Why value investing? Lower entry price means higher returns since 1881. This is the chart of the cyclically adjusted price earning multiple followed by the 10-year holding period return, which shows when you invest at low price earnings multiples, you tend to have a higher return, but over the long term, the effects over the short term are much less. And this is perhaps the dilemma for investors. They're saying that, well, you know, if we look at global markets, the US being the largest, it's trading at over 30 times cyclically adjusted PE. Traditionally, that would be associated with something like a 1% 10-year annualized holding period return, which it could be regarded as rather low and a bit of a problem. But let's just sort of dig into the market a little bit more, going on to the next slide, please, and look at global growth versus value, the historic performance. And I'd say there's three phases in this chart. One post the financial crisis, where value and growth actually pretty much delivered exactly the same level of return. The second phase, where investors started to realize that some of those digital franchises had real earnings power, developed quasi-oligopolistic positions in a number of key sectors, such as search or e-commerce. But there, you know, and as a strategist, I was reasonably relaxed about that because you had improving fundamentals and higher prices. But this COVID boom looks like it may have overshot. valuations have expanded, and it was something like a perfect storm for the growth sectors of the market, perhaps, as the real economy shut down and the digital earnings kept on powering forward. And we do notice that peak growth was actually October 2020, which is the same time as the first vaccine got approval. Next slide, please. So looking into the MSCI Global Value and Growth Index by sector, now we see what value investing might mean in practice from the top-down level. On the right-hand side, you've got the growth index with 35% of the weighting towards information technology, and a very small weighting towards financials. And on the value index, you've got 23% weighting towards financials, and maybe 9% weighting towards information technology. So what it means to be a value investor now is to be prepared to invest more in financials, be prepared to underweight information technology, and actually to run perhaps a more diversified portfolio. In the growth index at the moment, you've got this big IT weighting, but you've also got only a few other extra sectors which account for 3/4 of the index. Next slide, please. And as we drill down into top 10 index holdings, this concentration risk becomes more evident, because in the growth index, the top 10 holdings account for 33% of the index. In the value index, the top 10 holdings account for just under 12% of the index, which would be possibly more typical for a large index like this. And then looking at those stock names, of course, we also see some interesting sector definitions, because we've got Amazon, Facebook, Alphabet, not even classed as information technology. If we were to put those in as information technology, that information technology weighting would be closer to 50%. So if you're going to do value investing now, it does require a sort of a little bit of considered thought as to what you're underweighting relative to the rest of the market, and it is the information technology sector. But we think there might be some good reasons for doing that, regardless of some of the very attractive fundamentals of that sector at the moment. So the next slide, please. Because what we find is when we split the market out between the slower growing companies and the faster growing companies, the very fastest growing companies have been on something of a valuation excursion, which has been exaggerated by this dramatic outperformance in 2020 on the back of COVID-19. So the fastest growing quartile of stocks trading at something like a 100% premium to the historic average price to book, the fastest growing decile trading at something like 150% premium to its historic average price to book. In contrast, slower growing companies, while not at a discount, because that discounts were last year, we've had a big recovery since then, trading much closer to their long-term historic average price to book multiples, even in the context of a very low bond yield environment as we go through recovery. And that's a more interesting position for us as a starting point to make some investments. So next slide, please. So in terms of the macro outlook, which we think favors value over growth, we've got loose fiscal and monetary policy ahead for the next 18-24 months, a GDP rebound supporting corporate profits, the COVID recovery transitioning from digital back to the real economy, typically favoring the more cyclical sectors. But there's a key condition there, which is that these vaccination programs are effective and remain effective against new variants. Next slide, please. So in terms of monetary policy, taps are open and to stay open in 2021, with ongoing quantitative easing of getting about $200 billion between both sides of the Atlantic, and interest rates not forecast to rise until late 2022 at the earliest. Next slide, please. In terms of fiscal policy, there's just been an enormous fiscal response to COVID-19, and particularly in the US. The largest global market, the total of its fiscal stimulus plans amounted to something like 25% of GDP, and that compares to the response to the global financial crisis of just 5% of GDP. Next slide, please. As a result, with stimulus plus vaccines, which facilitate the release of lockdowns, we're looking at above trend GDP for the next 12 months. There's the IMF forecast on the left-hand side of this chart for GDP, annualized on a quarterly basis, showing 4% growth for 3 or 4 quarters before coming back to trend towards the end of 2022. And vaccination rates on the right-hand side, which show that the UK is ahead of the pack, reaching something, vaccination rate getting close to the levels required for herd immunity. The United States not far behind. The European Union's been slow, but I fully expect that by the autumn it will have caught up and be in a similar kind of position. Next slide, please. And so to add to the pump priming from the fiscal and monetary policy, we've also had this enormous savings boom, and it's possibly the case that this is like a second leg to the recovery coming in 2022. If unemployment can stay under control, then consumers maintain their confidence, a round of consumer spending to continue the recovery once it's been primed. And on the next slide, please. And as a result of this stimulus and and the increased confidence, we have seen over the last 6 months a trend of rising consensus earnings forecast for 2021, a trend we expect to continue as lockdowns are released. And then on the final slide, I think. Okay, so in summary, opportunity for global value being full-bore fiscal and monetary policy driving GDP back to trend over the next 2 years, earnings forecasts on the rise, the likelihood that science has tamed COVID-19, and we understand there's some risks around that with the new variants which have been found in India, for example, and that's something which investors will need to be attentive to, but it is time, we think, to look forward with valuations clearly favouring value sectors over growth at this time. So that's the end of my comments. So Rob, I'll hand it back to you, if I may. Thank you.
Thanks very much, Aleister. That's very good presentation, and it sets the scene very well. So we'll now go into a panel discussion, which will be for about 20 minutes or so, and then we'll open up for Q&A, which people can use via the chat function. So maybe let's just start off. We've, as Alice's chart shows, we've had a very long period of so-called value, and there's different interpretations of what that means, but let's say value and income or valuation sensitive type investors, significantly underperforming growth. Is value investing still relevant, and what is your approach, and how do you see the global aspect of what you do, or the multi-market aspect of what you do, as actually helping? So maybe I'll go round clockwise again. Start with Mike. Your focus a little bit more on Asia, but yeah, great to get your thoughts.
Yeah, well, you're absolutely right. I mean, for a value and income manager, the last 10 years hasn't been a whole lot of fun, to be fair. And since the recovery post GFC, I think it's fair to say that mostly the recovery's been fairly benign. So there was a lot of stimulus, all right, mostly monetary rather than fiscal post GFC, and the economic recovery globally, although it recovered fairly quickly, has been fairly benign since. So for a value investor looking for a backdrop of the cycle to help, it hasn't really worked. And this has obviously been accompanied by, as Aleister said, a period where digitalization of global economies has been a major theme. And that's now morphed itself into other areas, of whether it's environmental or other technological advancements, etc. So when you put those combinations together, you haven't got a cyclical backdrop. You've had some thematics which have played out and become even more relevant now than they were 10 years ago. And you've had this period whereby people were willing to pay whatever it took for growth, because, to be honest, there wasn't a whole lot of growth around. And that's why we've got to the extremes we currently have, which is levels of excess in certain parts, whereas the rest of it is, to be honest, quite cheap. And if I just look at my Asian universe, where we are now, and it's quite obvious why we started to see, in my opinion, the switch away from growth to value. Because when you look at the MSCI Asia Pac ex-Japan index, if you look at the growth index, it trades at 26 times PE, And for that, you're expecting 31% earnings growth. Now, the value index trades at 12 times PE, but you're getting 29% earnings growth. So you're getting half the multiple for 90% of the growth. So unsurprisingly, we've started to see people say, well, look, why am I paying this multiple when growth isn't scarce? Because at this point in time, growth isn't scarce. And it's that last point about those valuation differentials to me, which is key and plays in, to what we do, is that basically there is value in markets. Headline numbers suggest that markets are overextended, but that tends to focus on the now heavy weightings of one particular part of the index, which obviously takes the average far higher. But when you look beneath that and you look to value and you look to income stocks in general, which have been completely out of favor, then there's a lot of value indeed. So, unusually for me, if someone said to me that your market is at record highs, are you still finding opportunity? Normally I would turn around and say no. I'm getting a bit worried here. But actually, because we've got this massive divergence, there is opportunity. And in fact, when I look at what we own in the portfolio, we have a portfolio average of about 12 times PE with over 20% earnings growth and a 4.5% yield. And I can't remember having characteristics like that in the 25 years that I've managed money in Asia Pacific. So it's a really strange question to ask. Are markets overvalued? They are in part, but there's a lot of opportunity. And what we try and do is obviously find value. And I suppose we can discuss what value means to each of us. But in my case, it's all about the catalyst for me is through cash flow generation and dividend. And for that, there's plenty of opportunity.
Right, thanks, Mike. And we can maybe come on to income and so forth in due course as well. So maybe Joe, you've got a very global mandate and you invest in all sorts of things, including other closed-ended funds and so forth. So maybe you could discuss a little bit how you approach the value and the opportunities of a global universe.
Sure. Well, you start by asking whether value is relevant, and you won't be surprised to hear me say that I do believe that value is relevant. To the extent that value investing focuses on fundamental rational valuations, it absolutely is still very relevant. And as Mike was saying, we've been through a period of time in which investors have forgotten about rational fundamentals, and that's what very low interest rates does. It creates bubbles and makes them look very rational. And now we're coming to a point where investors are starting to scratch their heads and starting to wonder whether, in fact, this makes sense and whether there are areas of the market that perhaps have been overlooked, neglected, mispriced, and in fact, inefficiently priced. And that's really what interests us. So as you say, we do have a slightly differentiated approach. We're very keen on areas of the market that others aren't keen on. And we're particularly keen on investing in structures, listed structures, such as holding companies or conglomerates or other closed-end funds that are available on discounts and that give us access to good quality businesses and assets that are going to grow over time, but that trade on very wide discounts. And you see a lot of volatility in discounts over time. So a year ago, in the midst of the COVID sell-off, the discounts in our portfolio were a record wide 46%. Back in 2005-06, when value investing was all the vogue, discounts on average in our portfolio were around 10%. So as investor interest has been elsewhere over the past 10, 12 years, those discounts have been creeping ever wider, which means that with a global remit, there are a large number of areas of the market that remain inefficiently priced, that are trading on discounts, that we are able to capitalize on and position ourselves to benefit from the double whammy of growing values in good quality businesses, but also a narrowing of the discount that adds to the returns that we can generate.
Great, thanks for that, Joe. And you brought up an interesting comment there. I think you said something, things that are out of favour, and I think Aleister, you have quite a contrarian approach, again, similarly looking for unloved companies, again globally. So maybe you could talk a little bit about how you invest, how your investment process works.
Sure. Thank you. Well, I think we've all, just from our reading, we probably all know that everyone defines value and growth in completely different ways. And it sounds like actually today we're all probably on the same page, but some of the stuff I read, some people's definition of value is completely different to what I might consider. But what we do is we kind of think of value and it more in a context of, is the risk reward for an investment in our favor? And for us, it's if something is unloved, then that's a good thing. And why is that a good thing? Because generally when something's unloved, it's unloved because for a good reason. It's done badly fundamentally, and the share price will have done badly because the stock market does respond to fundamentals, and investors will be sick of it too. So we find that is an interesting area of the market, the unloved area, but then we try and combine that with a sort of valuation overlay to say, look, it's all very well to have an unloved stock, but for example, Netflix has disappointed overnight, and with its subscriber numbers, it will no doubt fall this afternoon. It will be unloved this afternoon, but we wouldn't find that interesting because from a valuation perspective, it still looks very, very expensive to us. So we're looking for sort of long-term multi-year underperformers that are unloved, that have the potential, look risk reward look interesting, i.e. you're hopefully not going to lose money. And if things go the right way, they'll respond to that incremental improvement. And just to broaden out, I mean, if you look at the market, generally the global market, and we're kind of touched on this already, but I'd almost say it's 50-50, the market. You've got half the market looks pretty overvalued and pretty aggressive assumptions behind a lot of the stocks and the way they're valued. And then you've got half the market where people are absolutely sick of it. They've had 10 terrible years. They don't believe that a lot of cyclical areas of the market can recover. And I guess all I would say is if you look back, say 10 years ago, if you recall when emerging markets were the big theme, you could hardly turn a page without someone recommending you must invest in emerging markets. And in fact, that was completely the wrong thing to do. It was actually, you probably should have been in the US, and buying technology would have been probably the best area to be in. I'm sure there was something better. But that's the key point. The key point is everything you read will tell you to invest in a certain way, just at the wrong time. Just now, everything's saying, you want to be in Bitcoin and SPACs and goodness knows what. But in reality, if you're looking in the unloved areas of the market, the things that everyone finds boring, that might well be where the opportunity is.
Great, thanks. I suppose one of the things about sort of value investing is the margin of safety, which you sort of touched on a little bit there, Aleister, sort of your risk of losing money, and if you are buying sort of less popular names, let's say, or they've had some issues. I mean, how do you look at protecting the downside? Is it just valuation, or what else do you look at in companies to give you that confidence that actually, even if things don't work out quite as well as you thought, you'll still come out okay? Maybe start with you, Aleister. Yeah.
Sorry. But the first thing to acknowledge is you're going to get things wrong. You will make mistakes. No matter how much work you do, things don't plan out the way you think. I mean, for example, I think George Soros has this theory of reflexivity, where basically when prices move in a particular way, it does prompt things to start going wrong. For example, when a company's share price falls a lot, the talented people start to want to leave, and that has its own knock-on consequences. But what we try to do is as follows. We first of all look at the fundamentals of the business and say, look, can this recover, from where we are now? Is it fundamentally challenged forever, or is there a cyclical element to it that means we can see an incremental improvement? And if we think that's the case, then we look at the balance sheet and we say, well, will this business survive a very severe downturn? Because it's no good being in a stock that will see upside on a 2 or 3 year view if you're not there to enjoy that upside. And then lastly, assuming those criteria are met, it's great to have an income from the stock, because frankly, timing it is extremely difficult. And if you can have a good dividend yield, which you often get in unloved stocks, then you're paid while you wait. And that's something that we take account of too.
Great, thanks. So Mike, I mean, you talked a bit about cash flow. What else are you looking at to protect the downside?
I think valuation, however you want to use, whichever valuation technique you use, whether it's asset value, cash flow based, earnings based, whatever, is a good starting point. It's a store of value. So basically, if you speak to a growth manager who focuses on structural growth, he'll basically tell you, well, this stock will be cheap in 10 years' time. But clearly, if it continues to grow, but no one knows what's going to happen in 10 years' time. And some of the excesses at the moment, that number's gone out to from 5 to 10 to 15 years in order to justify current price. So if you sit there with a stock which you think is cheap now, and he says, well, my stock will also be cheap in 10 years' time, I know which side of the bet I'd rather take, because I have no idea what's going to happen in 10 years. No one does. So if you have a stock which you think is fundamentally cheap now or fairly valued now, if things don't go the way you want, your downside is relatively limited. The same guy who's on a stock of 100 times, which will be 10 times PE in 10 years' time, if that goes wrong, the capital loss from getting that wrong is far greater than it is for someone who's got fundamental value, whether it's earnings, asset values, discounts to NAVs, whatever. The downside risk is limited if valuation is on your side.
Right, thanks. Joe, anything to add on to that from your point of view?
Yeah, like Aleister and Mike, we're interested in owning businesses that we think are going to survive, notwithstanding what the valuation is today. So we're looking at things like cash flow generation and balance sheet strength. But the other element that we bring into it, into a part of our portfolio at least, is shareholder activism. So is there something that we can do to crystallize an event that might unlock value? So, for example, we're pretty active in small cap companies in Japan, which have got huge amounts of cash on their balance sheets and good quality operating businesses alongside that, which aren't really properly valued by the market. But we're looking to get companies, the management, to do something about their undervaluation, whether it's share buybacks or returns of cash or more productive use of that cash in order to unlock that value. So we can afford to remain invested in those companies, given the very strong cash backing that they have, and be confident that they will survive over time. But in order to unlock value, we can give a bit of a shove along the way to get management to be more proactive.
Yeah, that's a good angle maybe to continue on a bit, because that forms part of the kind of ESG theme that is obviously prevalent right now, and probably will be. It's becoming embedded into most investors' processes now, and obviously in value sectors, sometimes you're buying those industries that on the face of it, won't look as cuddly from an ESG point of view. So just be interested in how you think about ESG. Is it compatible with sort of value investing? I can see on the governance side, but just be interested in your thoughts there. Maybe carry on, Joe, but just I'll throw that one at you first.
Okay. Yeah.
Since you started it.
Yeah, you're right. ESG is all the rage at the moment. It's very fashionable, and everybody's trying to demonstrate their ESG credentials, whether or not they're an ESG explicit fund or not. I think ESG is clearly very important in all types of investment. at the end of the day, we're investing in companies that we want to survive and prosper for many years and do good, not only for their shareholders, but for society at large. So to that extent, ESG is very, very relevant. I think what one needs to be mindful of is to avoid the box ticking that goes on, and just to tick boxes blindly and say, yes, we've got this ESG policy or that ESG policy, but to have something that's relevant and that's really going to add value. So it doesn't mean that you should exclude certain types of companies by virtue of their particular activity, but it does mean that as part of our fundamental research and will determine whether that company will prosper, we want to understand their attitudes towards the environment, the sustainability, and the communities they operate in.
Right. So maybe Aleister, I'll turn over to you next. I mean, you hold quite a lot of energy names now, and also miners, gold miners in particular as well. So just be interested in how you think about those positions in an ESG context.
Well, ESG has got three elements. There is, people will solely focus on the environmental aspect and say that trumps everything, and that you cannot invest in certain industries. But for us, we look at two things. We think ESG, the environmental, the sort of social aspect of it all, and the governance aspect are absolutely critical to every single investment decision we make, and they're all equally important. A governance issue is just as important as somebody, I say, a company that's treating its staff badly. These are all very important issues. Now, what we do, you raise the environmental issue. What we do is we look at the companies and say, for example, with energy, if we stopped using oil and gas today, our civilization as we know it would not exist. I know that we're all putting great efforts into being, using less energy, using less energy intensive ways of getting around. And there's a great deal of efforts being put into renewable energy. But as we saw in Texas just a few weeks ago, when you get an extreme event, we're utterly reliant on fossil fuels. And this is the case for at least the next couple of decades. So for us, we say with energy companies, we say these are absolutely essential to civilization. These are very useful companies, and that we should be encouraging the very best of behaviors, not just environmental, from these companies. And that the alternative to not investing in these companies, which by the way do look quite good value currently, is that they'll go off into private hands. They might be owned by, they're out of the public eye, and then you might get things done in a way that just actually does worse for overall society. So we think, do these businesses have a place in a modern society? Yes. And then if they do, how do they, how does that valuation fit into the whole risks that they might face from a whole series of factors? But actually, just on your point, I think with ESG, the S and the G are not given the prominence they deserve. I mean, for example, if you look at a lot of technology companies just now, they have huge G issues. And Mike might even be able to touch on, but some of the Chinese tech companies in particular have, you don't even own the underlying assets, if I understand it. So, there's lots of things to consider that aren't just environmental about ESG.
Oh yeah, that's a good point. I mean, you've got all the dual share classes, and yeah, the S with Deliveroo, in terms of how they treat employees. So yeah, that has been an issue that's come up recently, hasn't it? Mike, and I suppose when you're thinking about stakeholders, a lot of your underlying investors, whether it's through their ISAs or pension funds, or they're depending on the income for their livelihoods as well, from investing in Henderson Far East or any of the other companies here. So maybe you could talk a bit about that as well, just the overall stakeholder side of things.
Yeah, what specifically from ESG or from?
Yeah, I mean, yeah,
in
absolutely.
general.
Yeah.
Okay. Yeah, I think if you ask anybody about, you know, the importance of ESG, whether they're an investor, or fund manager, or whatever, they're always going to say that, you know, of course, this is really, really important, and all three are probably equally as important. It's slightly more difficult for us because obviously we invest in China, which manages to tick the box, the negative, or put a cross against E, S, and G, whether it's Xinjiang, whether it's governance, or whether it's environmental. So, you know, we have more challenges in that respect than most. But we take a similar view to Aleister and Joe, and it's about being pragmatic. You know, whether you're talking about a copper mine or iron ore or coal, ultimately these are all enablers of the transition to change, i.e., to a better environment. You know, as Aleister said, if you stop mining coal and stop producing oil, you know, the world changes far beyond what most people would want or most people would accept. So it's just not going to happen. So the important thing is to make sure that you are invested in the companies that are enabling the change, and through engagement, making sure they keep to the objectives they set. Now, you know, we will invest in virtually any company. We draw a line at munitions, but beyond that, there's, you know, every company to us is open, but we want to be invested in the best in class. We want to be there and hold these companies to attention about what they plan to do in all three of these areas: environmental, social, and governance. And I suppose in some ways, because our focus is so much on income, you know, income and governance do go hand in hand. Generally, if a company is willing to share its profits with its shareholders, that's probably the first tick in the box you'll get from a governance standpoint. So governance has been built into our process for a while. We've had to focus a bit more on environmental and social to a degree more recently. But it is important. But, you know, again, it's not a box ticking exercise. It's all about holding companies to task and about enabling the change towards a more cleaner and healthier environment.
Brilliant. So let's move on, just switch gears a bit. So looking at your portfolios today, and I mean, what do you see as the big opportunities from your point of view, you know, over the next 12 months, either, you know, sector-wise, geography-wise, or a couple of individual, or maybe one actually case study that you're very keen on right now that would be interesting to hear? Maybe start with Joe.
Picking on me, okay. Well, I think, you know, as Aleister George said in his presentation, I think we can look forward to more of this sort of COVID recovery theme playing out. So when we look at our portfolio, there are parts of the portfolio that have done extremely well out of the COVID environment, out of the lockdown environment. They tend to have more exposure to tech and that kind. And they are all at record highs and record valuations. Whereas there are other companies that have sound balance sheets, that have good business models, that have suffered the effects of lockdown. And as the world comes back to normal, you know, we see them as being major beneficiaries. They're still trading very cheaply, and they should really recover and do well, we think. You know, for example, here in the UK, we've got Associated British Foods that owns Primark. Primark's been closed for the best part of the year. Primark doesn't have an e-commerce online business, and so people want to go physically into the shops, and you can see that by the queues that are now prevalent every day, really, in Primarks across the country. So that kind of business trades very cheaply, hasn't recovered to pre-COVID levels. We'll probably see its business surpass pre-COVID levels over the next 12 months as it opens up and continues to grow. So that's just one example of kind of a value COVID recovery play that is well positioned, financially sound, and will see its business resume over time.
I think you're on mute, Rob.
Thanks. Aleister.
Oh, well, I think, look, there's a number of potential opportunities over the next 12 months. I mean, it's always hard to be precise on timings and so on, but I think there's the thing that's really interesting to us is that Aleister George covered at the beginning is this enormous government spending and the suppression of interest rates for the foreseeable future. And this potentially creates all sorts of opportunities. Now, the first thing is the reopening of the economy is going to be, we've seen this, a lot of people, it's not been good for everyone, of course, the COVID environment. We must stress that at the beginning, but for a lot of people, they've been able to save money and they've not been able to do what they want. So for example, a stock we bought was a few weeks ago was a company called Cheesecake Factory, which runs restaurants in the US on the logic that people would be very keen to go out to eat again once they could. But actually, it's moved very quickly. The market is doing what it always does and is anticipating what will probably happen. In terms of other areas that are interesting, I mean, inflation is here now, we think, for the next decade. This is the trade of the decade because the whole political environment has changed. I even heard Paul Mason, who used to be one of Jeremy Corbyn's lieutenants, used to be the economics editor at the BBC as well, quite a left-wing stance. And even he was saying he thinks what governments are doing with spending is great. In other words, now that politicians have discovered this magic formula of buying votes, it's not going to stop. So we're incredibly bullish about gold and gold miners in that context, because we think gold will perform its traditional role of being not so much making real money, but just holding its value in the context of lots of money printing. And lastly, financials look quite interesting as well, just because you've had a dreadful period, really, big picture, since the financial crisis. They've been under the cosh regulation-wise and interest rate-wise and so on and so on. But now interest rates are going up a bit. It's allowing them to make a spread again. The bad debts are nothing like as bad as they might have been feared a year ago. And actually, they're being allowed to price products as if there is a recession, a really bad recession on, even though clearly at the minute, the economy is actually roaring ahead. And just one example, I think with my own mortgage rate, I noticed that, which I fixed 3 years ago or something, you can't get that now. You have to pay a full percentage point more, even though interest rates are much lower than they were. So banks, for the first time, are being able to make a spread. First time in 15 years, are being allowed to make a spread and not getting political heat for it.
Right, Mike.
We're not too dissimilar, actually, yeah. Aleister. The ideal stock for us is a combination of growth, value, and income, and especially at the moment, it's very rare to get the combination of all three. And I would say that probably happens in two sectors: materials and financials. We're seeing growth in financials for the first time in a long time, partly because of interest rate expectations are rising and yield curves are steepening. So we're seeing net interest margins improve. Especially from an Asian context, we're not seeing the amount of bad debt, which was incorporated in prices certainly over the last 12 months. And we're seeing dividends return to where they were pre-crisis in a lot of countries, even above. So you've got that combination in financials. In materials, whether it's BHP or Rio, or we like diversified miners. We prefer specific miners in things like copper, aluminium, or lithium. Areas like this, there's still quite a lot of value here as well, especially if, like I do, that usually these things are classified as very cyclical because they're all about tied into an economic cycle. But I think there's more chance that some of these materials actually endure for longer than the cycle, because we now have more structural demand for things like copper, whether it's from electric vehicles or whether it's from different types of electricity generation, etc. All of them are more copper intensive than we've seen in the past, and that's more of a structural rather than a cyclical argument. Outside of that, we prefer enablers rather than the frontline headline platforms, if you like. So if you take tech, we wouldn't be investing in Alibaba or in Tencent because of valuations and little or no yield. But the enablers of these guys are the semiconductor sector or hardware components, and there are opportunities there as well. And I throw one out there, which is a sector which is hated everywhere, is telcos. And ultimately, these are a sector which has been forgotten about for a long, long time. They are high yield, they're cash flow generative. The problem has always been that there's no growth. Well, I think in a lot of places we can see consolidation of the telecoms industry. And my bet is that 5G ends up being more profitable for these guys than 4G. So you end up with stocks which potentially have a growth catalyst, but are valued as if they don't. So for us, it's a combination of all those three. But where we can find value in income and growth, that's where we're interested.
Brilliant. That's a good summary. Thank you, everyone. Maybe now we've got time for some Q&A. So yeah, if people just use the chat function, the Q&A function there. So we've got a couple in. Let me just have a look. Okay, so look, quite a few. That's a comment. Let's just give it time because someone's question was already asked about the oil and gas. Okay, here we go. Here's one. Inflation favors asset-light growth businesses as they don't have to replace depreciating assets at ever higher prices. Asset-light businesses are on high multiples, which may contract. What will win, the low multiple or the better business economics? It's a tricky one. I think Buffett describes inflation as a tax on capital, doesn't he? Well, who wants to go for that? Anyone want to put their hand up?
No, I don't mind having a go about the inflation expectations and what that does. I mean, and I'll talk about it specifically about how we think about it in terms of Henderson Far East. Now, clearly, we're an income fund, so income funds do tend to do better when interest rates are low, i.e., the spread of equity income yield over bonds and cash is as wide as possible. That's when we tend to attract capital into the asset class. That hasn't happened yet, I would add, despite the fact that differential is as wide as it's ever been, which is a positive point for yield. But what obviously could erode that differential be inflation over time and the expectation of interest rates rising and closing that gap. So although we don't look at the portfolio and look for opportunities top down, we are conscious of the fact that what we're sensitive to as a portfolio as a whole, which is one of the reasons, again, why we've looked at financials or parts of our universe which could effectively hedge against the high yield part of our portfolio, which is, for us, financials fills that gap. So obviously, if the fundamentals didn't stack up, then we wouldn't be looking there. But fortunately, they do stack up and they provide a natural hedge to the rest of the portfolio, which is why we find them interesting. And to a degree, commodities tend to do well in inflation cycles as well. So the combination of those two against a high yield for us is a combination which has some appeal.
Great. Anybody else want to add to that, or shall I move to the next one?
I'll just add a little on that. It's really real interest rates which will have the bigger effect on valuations rather than in higher nominal rates per se. So I think we're in a period where central banks have been pretty clear that they're going to tolerate higher inflation regions than they might have done in the past. I don't think that's going to be a threat to value-based businesses. But I think towards the back end of that period, people will be wondering about a return to normal real rates, and where you've got very high valuations for certain growth segments of the market, that's where the risk lies.
Yeah.
That's what I would say on that point.
Great. So maybe one for you, Aleister, is following the news this week, how do you see tobacco companies at the moment?
Well, I guess that's referring to the story that the US will potentially make tobacco products have a less addictive content to them. And I guess, to be honest, that can only be a good thing, really, for society at large, because I think everyone acknowledges that smoking isn't good for you. And if you can make it less addictive, if that is the only thing that makes people smoke, then that is definitely a good thing. We do have a small holding in a couple of tobacco holdings. Now, tobacco is really interesting. It's actually a great example of that whole industry being unloved, because if you remember 20 years ago, more than 20 years ago, 22 years ago, the tobacco had a terrible 10 years, if not longer. It had trouble with smoking, was clearly in decline in the Western world. And much more importantly, it was under the regulatory cosh for very good reasons, of course. And then, it was in about 1998 that the tobacco companies lost a lot of lawsuits in the US and had to pay hundreds of billions of dollars in compensation over very extended periods. So this was about the time I first joined markets, and I just thought, well, tobacco is uninvestable. But actually, for the best part of the next 20 years, tobacco was the best performing area of the market. It wasn't .com stocks, it wasn't Brazil, it wasn't China, it wasn't anything like that. It was the area that everyone hated 20 years ago. So fast forward to today, is tobacco hated again? Yes, it is to some extent. It's very much gone out of favor again. Some big dividend yields are on offer. Is it an industry in long-term decline? Absolutely. And I guess it's just about balancing that. The industry as a whole, though, by the way, is transitioning or trying to transition to the hopefully healthier products, these heat not burn products and so on. So potentially this is an unloved part of the market that might be able to forge a new future for itself in a new, healthier, but not necessarily good for you product category.
Right, thanks. So we've got a sort of a macro question here. Again, it's about bubbles, and so I'll try and praise these a bit. It's slightly complex, but it's basically back on inflation, saying should inflation emerge and long-term interest rate rise? I mean, I guess you partially answered this, Aleister, but just saying that if rates rise, I guess in absolute terms, isn't that going to wipe? If they've got a 2% risk-free rate, and and you add a 3% risk premium on something like that, you're going to get a massive drop in asset prices.
I think, Rob, where that's really much more relevant is towards the growth end of the market, which we're not talking about today.
Absolutely.
If you go back to the chart in the presentation, you'll see that valuations for the slower growing segments of the market, they're not cheap, i.e. they're not below long-term averages, but they're not so far above, especially in the context of big earnings recovery over the next couple of years. And then, that would leave them normally valued. And then the 2% interest rates plus then 4% long-term bond yields would be roughly the equilibrium kind of level for the theoretical wonderful world after we've got rid of all the transients. And so for the kind of stocks we're talking about today, I think it's less of a concern. But of course, if you have an uncontrolled rise in US 10-year rates this year, which isn't in our forecast base case or anything like that, because we think the Fed would have something to say and do about that. That would cause some market volatility, which would impact all sectors of the market in the short run, but not necessarily the values or the underlying fundamental value of some of the stocks we're talking about today.
Yeah, I mean, there's a follow-up actually to that, Aleister. What measures can central banks take to manage the yield curve? What do you expect they might do?
The things they've done so far are to fix the short-term price of money, to engage in asset purchases, to fix the long-term price of money, to engage in forward guidance, to fix the expectations of short-term interest rates. And they've also got involved where necessary, where they've deemed it as necessary, in credit easing programs to fix the cost of credit in various segments of the economy. I mean, they've got a pretty broad remit, and no one's put a limit or a constraint on their activities. So, and I think it would be inconsistent versus their prior behavior to, or illogical to think, given their private behavior, that they would not react to some undesirably sharp increase in long-term interest rates.
Yep, I think that's clear. Just going back to Asia again, I didn't realize myself, apparently Charlie Munger has bought some for the Daily Journal, some Alibaba. And do you have any thoughts about that? As a well-known value investor?
As a well-known value investor, yeah. I mean, actually, to be honest, Alibaba is not that expensive. I mean, we're talking about high teens multiples for the core business, which, to be honest, for a tech stock is an absolute bargain. However, the reason why it's cheap is interesting and probably ongoing. So obviously, you've got the issues with Jack Ma and whatever Jack Ma has done to the Chinese government, which has meant them clamp down on this platform. You've also got the structure of the business, which, although it's not such an issue now as it's listed in Hong Kong as well, but even so, there is some governance history about this company, which is a little unpalatable, to say the least. And then you've got to ask yourself about the regulatory framework in China. And I think the interesting question we should be asking ourselves is not about the regulatory framework in China, is about what the regulatory framework is going to look like the rest of the world. And I think China is a test case. It's probably more relevant because Baba and Ant Financial in particular is quite dominant in a lot of areas. And the Chinese government were very keen to allow and promote this platform, which is a world leader, both in online payments and in e-commerce. However, it's now got to the point where it's so large, it actually starts having an impact potentially on national issues. So that's why we've started seeing regulation, potentially regulation, to make sure that one or two or three companies don't become too dominant in one of the growth areas of China. I think the most relevant question here is what regulation's coming here to stop the dominance of some of these online platforms, and maybe China's a test case.
And you're seeing that in tax policy a little bit as well, that trying to clamp down on some of these sort of large global tech companies.
Well, we haven't even talked about, I know this is value, but, if you talk about the catalyst for change, the clear beneficiaries of COVID and companies that have done poorly. And there's here we are talking about, potential tax changes. And I think we know which way they're going to be focused going forward.
Yeah, absolutely.
So, maybe that's a further catalyst for switch out of some of the winners into the losers.
Yeah. Maybe one more question, maybe Joe, you could take this. How do you think about large pension liabilities when making investment decisions? I mean, I don't know if that's something you come across in some of these Japanese sort of companies that you invest in.
Yeah, well, it is something we come across in Japan, and clearly a lot of companies in Japan are run more for the benefit of employees and their ex-employees, their pensioners, than they are for current shareholders. So it is very relevant. And it does form part of our sum of the parts valuations. So you've got a company that has got an operating business that we value, you've got cash and securities on the balance sheet, and then you've got some liabilities. And very often the pension liabilities are the biggest component of those liabilities, and we deduct them and we account for them. So when we look at businesses, we're really trying to think about current market price relative to a realization value today. And the assumption being that if you liquidate those companies today, you have to pay off those liabilities.
Yeah.
So
So you think of it as a kind of debt, effectively.
Yeah, in certain companies. Yeah.
Yeah. Yeah. Great. I don't know if we have any more. Let's have a look. Maybe here's an interesting one. Do you think the importance or role of management teams in companies in terms of generating returns is different for value versus growth companies? I don't know if anybody wants to take that. Do you see any difference in the way they work for generating returns?
I'm happy to have a go.
Yeah.
I think that management is always important, and certainly as a minority shareholder in companies, you're dependent upon management doing a good job, and to the extent that they can rip you off, I think one always needs to be mindful of that. And I think it applies to both value and growth alike. I guess we've gotten used over the last decade plus to think that all growth stocks have gone up. So notwithstanding what management may or may not do to you as a minority, and that hasn't been the case in value. So there has to be more at the forefront of people's minds. But at the end of the day, I think one always needs to be conscious of what management's doing.
Great. Okay, I think we've run out of time. So thank you, presenters, Mike, Joe, Aleister. That has been very insightful listening to your take on things. Thanks to Aleister at Edison as well for the macro outlook. And thank you for everyone joining and for all your questions. If you would like to get in touch with any of the managers, please let us know, and we'll forward your details on if you'd like to talk more about their trusts. So with that, I think we'll draw it to a close. Thank you very much, everybody.
Thank you. Cheers.
Thank you.
Thanks.
Thank you, everyone. Thank you.
Bye.
Bye.